It's time for Global Insights, where we speak to experts from around the world on issues making headlines. As the war in Ukraine continues, Western countries and their allies have been introducing stronger sanctions on the Russian economy. But as much as the stringent sanctions on Russian entities and individuals are squeezing the Kremlin, the measures and the prolonged war are also weighing on economic conditions in Europe and around the world, including here in Asia. We discussed the growing impact of the war on economies and markets around the world. And for this, we're joined by Christopher Hartwell, Professor at the CHAW School of Management and Law, and Yang Jun-seok, Professor of Economics at the Catholic University of Korea. Thank you both very much for joining us today. And first off, Professor Hartwell, now, President Putin has vehemently denied that sanctions on Russia's economy is working, but do you think that's true? Do you think they're working? And also, do you think further sanctions could convince him to make some concessions in this war?
Well, I think what we've seen is very important that we say what the sanctions are working towards. What is our goal? What's our metric of success? And I'd say if we want to kind of cripple the Russian war machine, then we are actually having an effect with the current crop of sanctions. It's not gone as far as it could have been in terms of an embargo on oil and gas. However, we've seen indications that the Russian war machine itself is being harmed, that there's supply chain disruptions when it comes to the parts that are needed for creating new tanks, for creating some of the high technology anti-aircraft or missile systems that they have. While we might not see so much regular life in Moscow or St. Petersburg or even places like Vladivostok or Nizhny Novgorod being affected, and I hear from friends in Moscow that life is kind of slowly returning to normal, they are starting to have bite where it matters, and especially the kind of the seizure, the freezing of Central Bank of Russia assets, which is really, really hampering the Kremlin's ability to evade any further sanctions and to kind of buy its parts elsewhere.
And Professor Hartwell, of course, supply chain disruptions and just the war situation itself, it's been driving up price levels like crazy, especially in Europe. Now, how is the war situation and the sanctions, of course, on Russia impacting daily life for people in European countries?
Well, the only way that they're really feeding through is because of the volatility that comes with kind of oil prices. They've gone up. If you think of kind of West Texas or even Brent crude, it's gone up about 75% since February. So that's an immediate price hike that is hitting people in their pocketbooks, in their wallets. Other than that, food prices are rising, but were rising beforehand. This is just kind of, when you think about the amount of wheat, the amount of grain that comes out of Russia, that comes out of Ukraine, that is going to be problematic in terms of supply chain. So there's going to be less supply, and the demand's going to be the same or higher, so prices are going to be higher. But overall, kind of prices have been rising already because of central bank responses, because of kind of COVID fiscal stimulus. So it's inaccurate to attribute most of this to kind of the Russia-Ukraine war, especially since Russia only accounts for about 3% of the global economy.
Well, it seems that global investors are also, they seem concerned all the same. And Professor Yang, now going over to you. Now, concerns over the rising prices are prompting investors to sell bonds, and that's been pushing yields higher and higher. And the yield on the benchmark 10-year Treasury note in the US, it touched 2.94% last Tuesday. And that's a level not seen since late 2018. Now, first, what do bond yields indicate about the economy? And second, do you see the increase slowing down?
Okay, well, the two-year bond rate is 2.61, and 10-year rate is 2.94. So it does seem like the market is expecting large increases in the interest rate, but in the short run, not necessarily in the long run. And also the 2.94 yield rate is substantially below the consumer price index inflation of US, which last time around was 8.5%. So they seem to expect this high inflation not to last, but also be a very short-term type of situation, which may be good news for central banks, since it indicates that the inflationary expectation has not really gone up. People still expect this inflation to be temporary rather than permanent. But they do expect the interest rate to rise very quickly and very high. Right now, the expectation seems to be that the interest rate increase will take place every FOMC meeting. There's 6 left, and at least some of them will be big steps of 0.5 percentage point and even more. And I think that is reflected in the current 2-year and 10-year bond rate. But the lack of difference between the two does seem to indicate that once the rate goes up in the near future, it will not go up even further in the longer future. So far, they only expect the interest rate rise to be more or less in the short term.
Professor Yang, as you mentioned, the US Federal Reserve expects to hike interest rates at least 6 more times in 2022, while the European Central Bank also confirmed last week that it's ending its asset purchasing program in the 3rd quarter of this year. Now, if these more aggressive rate hikes are introduced by central banks, then what's going to be the impact on Asian markets? Do you expect more sell-offs to happen?
Okay, well, I did a little bit of calculation comparing the current stock market numbers to where it was before the pandemic started, the 1st quarter of 2020, the high points of 1st quarter compared to where it is right now. And Dow is about 14% above, S&P is about 26% above, NASDAQ about 30% above, Nikkei about 10% above, Kospi about 17%, Kosdaq about 30% above where the highs used to be 2 years ago, just before the pandemic. Now, roughly you expect about 10% gain on stock per year. So that does seem to indicate that a lot of bubble has gone down. There is, for some markets like Shanghai and Hang Seng, they're lower than where it was before the pandemic. So while the bubble has gone down quite a bit, just because the interest rate is rising, we will probably see additional sell-offs. It'll be very volatile for the first part of the year, but things may stabilize around the current levels once the invasion settles a bit and the bottlenecks that we see in the supply side settles down a bit. And when the U.S. does raise the interest rate, that may cut down U.S. spending, which is one of the main causes of the inflation that we see right now.
In the meantime, it seems Russian President Vladimir Putin isn't backing down. And Professor Hartwell, now earlier this month, an overwhelming majority of EU lawmakers, they demanded an immediate full embargo on Russian oil, gas and coal. But why is it so difficult to actually implement this embargo? What would sanctions on Russian energy mean for Europe?
Well, there are 3 easy answers to that, why it's so difficult. Germany, Austria, Hungary. You have 3 countries which are dead set against kind of moving forward and having this full embargo. Most of what we see, kind of the reluctance to move ahead, is because these very same countries, during the good years, as it were, didn't provision themselves at all for any kind of alternatives to Russian oil and gas. They have become more and more dependent. You know, there's that clip floating around the internet of Donald Trump at the UN saying that the Germans would become entirely dependent on Russian oil and gas, and they're just laughing it up. This is exactly what has happened. There have been no kind of moves away from Russian oil and gas. Germany is highly dependent. They are closing their nuclear power plants, and they are not even entertaining the idea that perhaps this is a bad idea and maybe they should reverse those closures. Austria has its own kind of special history when it comes with Russia, being neutral because of Soviet occupation until 1955, and of course Hungary is being led by Viktor Orban, who is very much pro-Putin. He portrays himself as pro-Hungary. He's keeping us out of the war, but in fact he is very, very pro-Putin. So the infrastructure isn't there really to kind of shift away very quickly from Russian oil and gas, mainly because of countries like Germany, Hungary, and Austria, which have made no provisions for it. It can be done. Other countries in the European Union have started to diversify. We've had Poland, Lithuania building kind of their LNG, their liquid natural gas. We see that France is kind of looking towards Qatar and looking elsewhere in the world. But as long as Germany, Austria, and Hungary are blocking it, then it's not going to go anywhere.
Well, Professor Hartwell, now governments like the UK, they've been trying to they've been trying to stem the flow of money, the Russian oligarchs' cash flow, and also they've been trying to strengthen sanctions on Russia's goods and, of course, energy as well, eventually. But how are they really preparing for the fallout that will come inevitably to their own economies?
Well, they really are. And I mean, there's not much that's going to happen when it comes to sanctioning oligarchs. I mean, we've talked about this before, that it's the common way to go, and it's mostly symbolic, that you go after these specific people who have lots of money and have ties to the regime, and then say that they can't operate here, there, everywhere. And it matters in terms of the London real estate market, in terms of the amount of money that's gone into the London real estate market coming from Russian oligarchs and kind of associated oligarchs throughout Central Asia and even Ukraine. But I think the London real estate market can withstand a hit such as this, kind of the withdrawal of oligarch money. Otherwise, there's really not much else that's being done. Again, food prices will probably increase due to disruptions in supply chains, but I think, again, this is part of a general rising tide of prices. The only thing that the UK government or other European governments can do is, as Professor Young kind of counseled, it's monetary policy. It's increasing interest rates. It is actually accurately pricing capital, which has been mispriced for years. So, but that is going to have its own kind of consequences in terms of economic recession as the bubbles burst. And I want to add one more thing to kind of what Professor Young said, and I agree entirely, but the markets might not be expecting inflation to last that long. The inflation has already escaped. I mentioned the London real estate market. You look at the United States real estate market. You look at real estate across Europe. Now we are into asset inflation, which is where we were in 2007 and 2008. So this is the dangerous point for kind of the global economy. I don't think anyone is really taking that very seriously beyond kind of what happens with Russia and Ukraine.
But Professor Yang, well, the reality is that the Ukraine war is stretching on, and the price of food, gas and commodities, people are very worried that they're going to continue shooting up. Do you expect inflation to continue for the time being? And do you think measures like US President Biden's plan to release 60 million barrels of oil could make a difference?
Okay, well, I do expect the inflation to be worse than what the bond market expects. I think it'll last longer, but I think we will not. We have sort of hit peak inflation. I think the inflation rate will go down, but perhaps not to the levels of what the central banks want for 2% range for about maybe at least until next year, perhaps even a year afterwards. Now, will President Biden's 60 million barrels of oil make that much of a difference? Well, the world oil demand is about 89 million barrels per day. Russian exports is about 2.9 million barrels per day. So this is, if you talk about the daily demand, it's not even 1 day's demand. If you talk about Russian exports, it's about 25 days worth of Russian exports. So unless OPEC steps up and increases its production, or the demand falls significantly, which means that we will go into recession globally, I don't think the 60 million barrels just by itself will make all that much of a difference.
And adding to that, Professor Yang, well, the international banks, the International Monetary Fund, the World Bank, they've been downgrading their projections for the global economy, including here in the Asia region. And how are Asian economies going to be affected by the Russia-Ukraine war, particularly the South Korean economy?
Okay, well, I'm personally more concerned about food prices than oil prices because, well, oil prices, OPEC is not cooperating, but if OPEC does decide to cooperate, then we could have a relatively rapid decline in oil prices. But grain prices, because of the hit in Ukraine production as well as sanctions on Russia. And it takes about 6 months to a year to step up grain production. So this grain production, the hit in grain production will be, I think, longer lasting. And because the Asian region imports a lot of grain as well as oil, especially Korea, I think it will have a higher than average globally effect on Asian countries. But I also noticed that the latest projection by Asian +3 Macroeconomic Research Office says that they reduced the growth projection from 3.9% to 4.9% to 4.7%. That's only about 0.2 percentage point difference. Now, Korean exports, about half of Korean exports do go to Asian +3 countries, ASEAN, 10 countries plus China and Japan. But if the reduction in growth is only about 0.2 percentage points, I don't think that'll be too hard of a hit on Korea.
Well, we're out of time, I'm afraid, so this is where we must leave it today. That was Christopher Hartwell, Professor at the ZHAW School of Management and Law, and Yang Jun-seok, Professor of Economics at the Catholic University of Korea. Thank you both so much for joining us today.
Thank you.